Hello students, we are talking about assessment of firms. In the previous session we studied about key features of assessment of a firm. In this session let us discuss about alternate minimum tax. Alternate minimum tax is a minimum tax leviable alternative to normal tax payable on the total income of the firm. The rate of alternate minimum tax is 18.5% plus applicable surcharge and cess. Surcharge applicable to firms is 12% if the income is above 1 crore and education cess 4%. This AMT, that is alternate minimum tax, is a tax levied on adjusted total income. Here you have to calculate the adjusted total income in a financial year wherein tax on normal income is lower than alternate minimum tax on adjusted total income. If the actual tax calculated on total income is less than alternate minimum tax, then only the provisions of this AMT is applicable to the taxpayer. If this AMT is less than the actual, that is normal tax calculated on total income, this provisions is not applicable. Remember that point also. The provisions of alternate minimum tax is applicable only to non-corporate assessees. For corporate assessees, that is for companies, MAT is applicable, that you know already. So, for non-corporate assessees only this alternate minimum tax is applicable under section 115 JC to 115 JF. Next, let us know about the applicability of alternate minimum tax. This AMT shall apply to a non-corporate assessee and the taxpayer who have claimed deduction in respect of certain incomes under section 80 IA to 80 RRB except 80P. provided in respect of profits and gains of specific industries such as hotel business, small scale industrial undertakings, export business, infrastructure development, etc. But deduction under section 80P, which provides deduction to corporate societies, that is cooperative societies, is excluded for this purpose. For the calculation of adjusted total income, you have to exclude 80P because this 80P is relating to cooperative societies and not relating to the firm. Next, section 10AA, that is profit linked deduction under section 10AA, deduction of profits varying from 100% to 50% is provided to units in special economic zones. We are going to study about this section 80 IA to 80 RRB and section 10AA and section 35 AD in the next session. So, I will go in detail in that session about these sections. Okay. Next, deduction under section 35 AD, that is 100% deduction is allowed on capital expenditure incurred for specified business like operation of cold chain facility, that is refrigerating and storing and distribution activities relating to temperature controlled supply chain. Not necessary to know this in detail because they will give section 35 AD only. Next, fertilizer production etc. is relating to section 35 AD. Remember this thing, section 35 AD is relating to capital expenditure incurred in a year. Deduction is allowable at the rate of 100% under this section. So, alternate minimum tax provisions are applicable only when normal tax payable is lower than alternate minimum tax if any financial year. In any financial year, if normal tax is higher than the alternate minimum tax, they have to pay the normal tax only, as I told earlier. Then what are the non-applicability of alternate minimum tax? That is, who and all not to pay this alternate minimum tax. That is, an individual or a Hindu undivided family or an association of persons or a body of individuals or an artificial juridical person referred to in section 2 subsection 31 clause 7. These people are no need to pay the alternative minimum tax provided if adjusted total income of such person does not exceed rupees 20 lakh. If the total income of these parties, that is adjusted total income, does not exceed 20 lakh, they no need to pay alternate minimum tax. If their adjusted total income exceeds 20 lakh, they have to pay the alternate minimum tax. So, this is about the non-applicability of alternate minimum tax. Next, let us see how to calculate this alternate minimum tax, that is steps to be followed for the calculation of AMT. The first step is you have to calculate the regular income tax liability of the SSC, that is calculation of regular income tax liability at the rate of 30% of total income plus education cess of 4% plus surcharge if any. That is the first step, calculation of regular income tax liability at the rate of 30% of total income. Second step is calculation of adjusted total income. Adjusted total income is calculated as follows, that is total income plus if here it is given as ATI is total income as increased by means total income plus, okay, plus amount claimed under section 80IA to 80 RRB except ATP as I told you earlier, and amount claimed under section 10 AA and deduction claimed under section 35 AD if any. After calculating adjusted total income, you have to calculate AMT, that is alternate minimum tax, by applying 18.5% plus applicable surcharge and cess. Surcharge if the total income exceeds 1 crore 12% and education cess at the rate of 4%. The third step is to calculate the alternate minimum tax. After calculating this alternate minimum tax, the next step is comparing the tax liability calculated on normal income in step 1 and alternate minimum tax computed on adjusted total income in step 3. You have to compare these two things. As I told you, if the normal tax is more than alternate minimum tax is not applicable. You have to pay the normal tax only, because higher value you have to pay. If the normal tax is more, you have to pay the normal tax. If the alternate minimum tax is more, you have to pay that, a simple thing. Here not required to pay the alternate minimum tax if the normal tax, that is actual tax liability calculated on total income is more. Next step is, if the alternate minimum tax is more than normal tax, the difference amount is available as tax credit. Tax credit is nothing but the benefit available to the firm. Let us study about this in detail. See, tax credit The excess amount can be carried forward and set off against regular tax liability in the subsequent assessment year, that is maximum of 15 assessment year. They can use this tax credit for the maximum period of 15 years, that is with effect from 2018-19, and no interest is payable on such credit. Tax credit is the difference between the tax paid under alternate minimum tax and tax paid under normal tax, and they can use this benefit of tax credit in the subsequent years, that is subsequent 15 assessment years. Suppose the tax payable on total income is 20,000 and tax has been paid under adjusted total income is 50,000. The tax credit will be allowed rupees 30,000, that is the difference between AMT and the normal tax. If the AMT is more than normal tax, they have to pay the AMT only, and the difference between the two is available to the taxpayer as tax credit. In the years where the normal tax is more than the AMT, you can use this tax credit for the benefit of the firm. Let us see that in next step. See, the tax credit will be allowed to be carried forward for a maximum of 15 assessment years, as I told you, succeeding the assessment year in which the credit becomes allowable. Suppose credit is allowable in the assessment year 2018-19, it can be carried forward and set off up to assessment year 2033-34, that is up to 15 assessment year they can use this tax credit. The tax credit will be allowed in the year in which the tax payable on total income is more than the tax payable under alternate minimum tax. If the normal tax is more than AMT, you can use this tax credit. The set off will be allowed to the extent of an amount equal to the difference between two taxes. Suppose carry forward tax credit is 40,000. Remember this point. Carry forward tax credit, that is tax credit available to the firm is 40,000, and the normal tax, that is tax on total income is 1 lakh and AMT is 80,000. The difference between the two is 20,000. You can use this 20,000 to reduce your tax liability in that assessment year, that is the available tax credit is 40,000 and the difference between the normal tax and AMT is 20,000, and that 20,000 can be set off and the assessee will pay only 80,000 rupees. If this tax credit is not available with the firm, he will be payable rupees 1 lakh, because higher of normal tax and AMT they have to pay. Here in both the normal tax and AMT, which amount is higher, they have to pay. Because of this tax credit available with him, he can reduce his tax liability to the extent of the difference between the two. You will understand about this while solving the problem, so no need to worry about this now itself. Next, the last step is, if the provisions of alternate minimum tax are applicable, the assessee has to obtain a report in form number 29C from a chartered accountant. Every person who is liable to alternate minimum tax shall obtain a report in the prescribed form from chartered accountant certifying that the adjusted total income and AMT have been computed in accordance with the provisions of this chapter, and the person shall furnish such report electronically on or before the due date of filing the return of income under section 139 subsection 1. Okay, this is about alternate minimum tax. Alternate minimum tax is applicable to non-corporate SSC who has claimed deduction under these 3 sections, and the rate of alternate minimum tax is 18.5% plus applicable surcharge and cess, and the provisions of AMT is available only in the financial year where the normal income is lower than the adjusted total income, that is normal tax is lower than the AMT. So, this is about alternate minimum tax, and in the next session let us discuss about the sections, that is deduction from 80 IA to 80 RRB and section 10 AA and section 35 AD. Thank you. Let us meet in the next session.